All right, everyone, we're going to go ahead and get started. Hello and welcome to today's webinar, Basic Bookkeeping for Small Businesses. I'm Jolene Carey Pace, the Program Coordinator at the Wilkes University Small Business Development Center, and I'm so happy that all of you could join us here this afternoon. Before we begin, I would like to thank Ray Hayden and Lucy Singer, two of our business consultants at the Wilkes SBDC, for sharing their presentation today. Just a quick note to please put yourselves on mute so that we can avoid having any background noise. Also, as we go along, you can type any questions that you might have into the chat box, and I can help field those to Lucy and Ray. And there will also be time at the end of the presentation to ask any questions that you might have. And now I'll hand it over to Lucy and Ray. Thank you.
And guys, can you hear me okay? Just make sure if you can give me like a thumbs up. Um, Again, as Joe had mentioned, this is basic bookkeeping. We're going to be covering some best practices and general information. You'll see that our funders are articulated at the bottom of this initial slide, including the Commonwealth of Pennsylvania, the SBA, and we've also received CARES Act funding to put this on for y'all, all right? I always like to start our presentations with things that we're like that we would like to cover. Okay, so first off, I think it's always a good idea to have an idea of where you're getting your information from. So in that regard, I'd like to give a little bit of a brief overview regarding our operation, which is a small business development center at Wilkes University. We're going to go over a brief introduction to financial statements, tips and best practices for bookkeeping, and they might seem like two different topics, but believe you me, they are tied together. We'll go over some final thoughts with regard to this presentation. We do have a number of references to share with you guys. We will leave time for Q&A. And once we're done, if there are no questions, then we'll let you guys go. All right. So let's go over with whom we are. This is what I like to call the overview slide. What is the SBDC when you get right down to it? So we're an organizational partnership funded by our various funding sources. So that includes federal channels, specifically the Small Business Administration. If you're checking out the news, then you're probably well aware that the SBA has been um, releasing relief programs, especially by way of loan programs. In the last few months, you've probably seen a lot in the way of EIDL loans, as well as paycheck protection. So EIDL stands for Economic Injury Disaster Loan Program, and then Paycheck Protection Program for the PPP, okay? You'll also see that one of our our funding partners rather is the Pennsylvania Community Department of Community and Economic Development, also known as CCAD. And then our host institution, which is Wilkes University. And at the forefront of our operation is providing clients with confidential consulting and low cost training, oftentimes, and especially with the pandemic that's occurred, in the recent months, it's been more like no cost training for individuals looking to start or expand or are looking for help with their small businesses. It's important for us to articulate what we do not provide financing for, and I will include a little bit more in the following slide. But with regard to our territory, one thing to take into consideration is that we are broken out by territory. So we do serve a 5-county region. For the attendees here, you might not belong to the 5-county region. That's totally okay that you're participating in this webinar, but you might actually ultimately be looking at a different center for your ongoing technical assistance and counseling. On to slide 4. All right, and this is where I cover the things that we don't do, but some examples of what we do. Business plans we help with. We can't write the business plans for you, but we can certainly help you and get you on your way so that you're starting with your best foot forward, okay? Oftentimes, if you're looking at financing, all right, pro forma financial projections are required by lenders and other folks who are looking to lend you money, and we can help with that process as well. Research, we are hosted by a learning institution. So one of the things that we are able to help for our small business clients is the research endeavors, guidance on entity structure, and oftentimes if that's not something, or if it's um, beyond what you're looking for, we can always hook you up with additional resources with our funding, with our partners. And then we can also help you be more cognizant of various marketing strategies as well. But these are the things that we don't do. All right. So that includes financing, grants. We can't write the business plan for you, but like I said before, we can help you on your way. We can't negotiate on your behalf. So if you're approaching a lender and say, the conversation tends towards, well, if I do this, that, and the other thing, if we can drop, could you drop the interest rate by like 200 basis points? Those aren't conversations that we can have on behalf of you, but we can certainly prep you for those conversations. We really can't provide accounting or legal advice. And lastly, we can't do anything in terms of working with nonprofits. If you are set on becoming a nonprofit, certainly have that conversation with us sooner versus later, and we can hook you up with appropriate guidance. Alrighty. So as I had mentioned before, one of the things that we really want to start off with was an overview of financial statements. And sometimes this is a little scary for some folks. To be honest, with a lot of our small business clients, they're so much more comfortable doing the actual business than actually reporting on what they've done, right? When you get right down to it, and reporting the figures that are behind the actual productivity resulting from their small business. But financial statements are essential, and especially if you're in a situation when you are looking for financing from, oh, a bank, a credit union, some sort of other financier. Financial statements are super, super important. And what financial statements do, as you can see from that first bullet point, it shows where money came from, where it went, where it is now. So it's very, very much cash flow and money oriented, okay? In terms of actual financial statements, we're really going to cover three in particular, but there are four in total. I'd like to start it off with the balance sheet. And essentially, the balance sheet, when you get right down to it, a simple definition is really what the business owes and owns at a fixed point in time. Okay. Think about it almost kind of like in the same way that you would check your checking account or your savings account balance, right? When you go onto your online banking, what do you see? But you see what your balance is that day. That's that fixed point in time. So keep that in mind as we discuss things related to the balance sheet. Income statement, that's more over a span of time, okay? So how much money a company made and spent over a period of time. So usually if you see something, let's just say you're a business, your calendar, your fiscal year matches with the calendar year, and a calendar year ends right 12/31, and whatever the year is at that given point of time. So if you have a situation where you're looking at the first 3 months of financial activity as it relates to what you've made and what you've spent, normally for those businesses, it would be January, February, and March of a given year, okay? That's also known as the profit and loss. Those you will see in this presentation, and as you work with lenders and other financiers, are interchangeable. Next is the cash flow statement, which is the exchange of money between a company and the outside world. And this is also shown as a period of time, okay? So the cash flow statement might take into consideration, we'll go into this in a little more depth as the presentation goes on, but the cash flow statement might take into consideration um, changes in your income statement as well as changes in your balance sheet, okay? That might sound a little cryptic right now, but I promise it'll make more sense as the presentation goes on. And then the statement of shareholders' equity, guys, that's kind of built into your balance sheet because the balance sheet also articulates what the equity balances are. Equity, if you think about it from very practical terms, okay, when you think of like homeowners equity, that's the amount that kind of is what you owe in terms of your in terms of your property, okay? So oftentimes if you're talking about equity, when you're talking about your home, you're thinking about maybe what your appraised value is minus maybe what you owe on your property. That's usually your mortgage, right? And then the difference is essentially your equity or what you owe or what you own for your business, okay? And again, just to simplify things, we're just going to focus on the first three aspects of financial statements. The balance sheet slide here. That starts off with a simple accounting equation of assets equaling your liabilities and your equity. Okay. As I had mentioned before, your balance sheet is a point in time statement. Again, kind of keep that referential point in mind. When you pull your checking account, when you pull your savings account off of your online banking, you're looking at what your balance is at a specific point in time. All right. The balance sheet, as you can pretty much tell from that equation, is made up of things that you owe and things that you own. Okay, so in terms of the latter, the things that you own are your assets. What you owe is your liabilities. In terms of assets, these are things that have value, folks. All right. So, oftentimes for small businesses, these are the assets that you have to support the products and services that you have to offer. Okay. So if it's machinery and equipment, you're making widgets, or let's just say, just as an off the wall example, you're an artist. All right. So you might see amongst your equipment canvases and paints and brushes and things like that. And it might seem very not complex, but you would consider those things as assets to your operation. Okay. These things, so when I talk about assets, normally you'll think of things in terms of what is tangible and what is intangible. So if you think about it, equipment, that's definitely tangible. All right. Um, Furniture and fixtures, those are things that you would tend to own, unless, of course, you're leasing them. But if you own them, they would definitely be considered your assets. So, um, computers and printers and copiers and the sofas that you have in your waiting room, and heck, even like maybe the pieces of art that you have hanging in your office, those would all be considered assets, and they would all fall under what's called FF&E, furniture, fixtures, and equipment. Folks, just because you own stuff doesn't mean that you can't own stuff that isn't tangible, and you'll see that in the following bullet point. So if you have an operation that's very much tech oriented, where you have patents or trademarks, things of that nature, that intellectual property, you might not be able to touch it, right? Hence the tangible and tangible situation. But it's certainly something that you have in your court as something that you own and something that adds value to your operation. Ergo, those are definitely assets. What if you're some sort of situation where you're like a bar and restaurant? Well, if you're a bar and restaurant, then more likely than not, and if it's not, we really should have this conversation. But if you're a bar, you should probably have a liquor license, okay? And that is considered an intangible asset, right? Think about it. When was the last time you were really, other than like the paperwork, right, that you're actually able to hold? Can you really hold a license? No, not really, other than that. So that's considered an intangible asset, okay? Beyond the intangible and tangible perspective of things, you also have a situation where you break your assets into current and non-current assets. Okay, so current assets are the things that can be convertible into cash within a year. All right, so then the stuff that you have, and the stuff, I mean, like the cash or the money that you have in your checking or your savings accounts for your business, or whatever you have that are deposit accounts, those are definitely current assets. Why? Because they're instantaneously considered cash. All right. Inventory, for a lot of folks, that's convertible within 12 months. Okay, so that would be something that you would add as current assets. If you're a gift store and you have teddy bears and stuff like that on the racks, more often than not, you're expecting to sell those things within 12 months, if not much, much sooner. And that's another conversation that, as you develop your relationship with SBDC, inventory management, definitely something we want to talk about, especially if you're starting out. Accounts receivable. You've extended a service or a product to folks, right, on credit. Those are accounts receivable, and that's something that you want to track, because that's convertible into cash. And if it's taking way too long for what you have extended on credit to be convertible into cash, That's something definitely that you want to take into consideration and something that you really want to be concerned about, guys, because ultimately, um, you want your assets, you want your inventory, you want your receivables to be cash in your pocket. Non-current ash might be, or non-current assets rather, they're the fixed assets would be things like vehicles, your office furniture, which we had talked about, personal property. And obviously, when you get right down to it, non-current assets would be considered harder to convert to cash. So think about that. Like if you've been in business for a while, you have a piece of equipment that you're trying to unload. Um, think about all the things that you have to do in order to sell it. Maybe you have to put like advertisements out there or something like that, or maybe you have to post about it. But it normally, and you have to secure a buyer, right? So these are all the things that articulate the point that it's harder to convert to cash because when you get right down to it, most folks, especially if you're leveraging off of that equipment to do business, you're not in the business of selling that equipment, if that makes any sense. All right. Liabilities. So that is the what you owe to others part of the balance sheet. Okay. And what does that consist of? Well, that consists of normally for most small businesses, bank loans, money owed to suppliers. And what I'm talking about in that regard is you'll see like accounts payable for a lot of folks, right? If you are making purchases off of some level of credit where it's payable within 30, 60, 90 days, that's considered a payable. If you're an operation where you have significant employees, right? They work a set amount of hours for you, you owe them a set amount of dollars. And that's considered something that's on the liabilities end of the balance sheet. And of course, like taxes, guys. I mean, if you have some sort of business that doesn't owe taxes, I've never heard of it, but good for you if you're able to find that for yourselves. But more often than not, you're probably going to owe taxes in some way, shape, or form. All right. And that is something that's payable. That's something that you owe, or go, that is a liability. All right. You can divide liabilities into current and non current categories. So, currents would be like your accounts payable. Folks, oftentimes when you're pursuing credit to purchase things, or if you're looking to start up, oftentimes maybe with your commercial lender, you'll have talks about access to working capital, ways to supplement your working capital. And oftentimes banks will leverage off of lines of credit for you to do that, okay? The normal expectation with lines of credit is that it is a temporary means, all right? It's a temporary means for you to have access to supplemental working capital. And ultimately, you're expected to satisfy the balance on a line of credit, and that's normally done within 12 months. All right. Current maturities of long term debt. The amount of your term debt that is owed within a given or a rolling 12-month period. That's usually what's considered as current maturities of long term debt. So you started a loan, right? You've closed on a loan. The principal payments that you owe from month 1 through month 12 after closing on that loan is considered your current maturities. And then, of course, long-term maturities or long-term liabilities are beyond the 1 year term. When you have long-term liabilities, that's normally associated with term loans. And guys, if you have any questions, feel free to let me know. The stockholders' equity is the amount that owners invest into a company. All right. Um, let's take a simple example, actually. Let's just say you have started a business and you are looking at purchasing real estate. You need an office space or you need some sort of facility to actually do business. Say for easy math, that facility is $100,000. Okay. Um, $80,000 is money that you had to borrow from the bank. Okay. So that is essentially your your liabilities. If you've put in $20,000 towards the purchase of the property, because the purchase of the property requires $100,000, that's the sales price, then the $20,000 represents your equity investment or your ownership investment into the purchase. When you look at the assets, the liabilities, and the equity component, and say it specifically revolves around this purchase, okay? In terms of like a balance sheet, you would see on the assets the real estate of $100,000. Okay. You needed to borrow $80,000 to actually purchase the building. So on the liability side, you would see $80,000 as part of that balance. Remember, everything is kind of balance oriented. It's not just clever terms. That's why it's called a balance sheet, guys. And then $20,000 would be reflected in your equity because that's what you've contributed to actually own the real estate in this specific circumstance. Okay, that's just a simple example. um I really wanted to close on some quick balance sheet notes. As I've mentioned before, the accounting equation, when you get right down to it, um it's really always going to be this way. Your assets always equal your liabilities plus your equity. All right. Your balance sheet, just to re-articulate, the balance sheet shows a snapshot of company's assets, liabilities, and equity at a given point in time. All right. What this doesn't show, and I'm excited to get into this with you, is it doesn't show the cash in or cash out of the situation. So that's where the income statement comes in. This is a span of time versus point in time financial statement. And what this articulates is what your revenue is, what you made, and your costs and expenses, what you spent. And essentially, the difference is your net figure, your net income. Costs and expenses are generally divided into two categories: your direct costs or cost of goods sold, the costs associated with sales. Okay, so think about things in terms of if you're if you're a store, the actual cost of the inventory for the sale, all right, is going to be your cost of goods sold. So let's just say you sold a product for $10. How much did it cost for you to have that product on your shelf per unit? It might be $5. So that $5 is essentially your cost of goods sold. All right. Let's just say you have a situation where you have a realtor operation, okay, and your revenue stream has to do with commissions, okay. Well, your commissions are predicated on the sale of that property, right? So you can't claim direct costs until that sale actually happens. So that's how sales, how that's how direct costs, again, not just a fancy term, but it's directed to the actual sale of the service or the product. Now, operating costs, this is also known as selling, general, and administrative costs. I like to call this as the whether you make $100 or no dollars whatsoever, if you're in business, you'll likely have these costs associated with your operation. Things like salaries if you have a staff, things like rent if you have a location and you don't actually own the property. If you have utilities, regardless, you're probably going to have an electric bill, water bill, things like that. And marketing expenses also. All right. If you've contracted with a third party to do your marketing, regardless of how much money, unless, of course, you've established something contractual, um, you're going to have that annual marketing, or not just an annual marketing expense, but probably a monthly marketing expense, depending on the situation. Then there are interest and depreciation expenses. Interest, if you are paying interest on loans, that's definitely an expense. Depreciation is a non-cash expense, all right, but something that you can expense if you have equipment that you've purchased, okay? And then the bottom line is the net losses or earnings, okay? The earnings per share is the amount of money shareholders would receive if the company decides to distribute all of the net earnings. So let's just say at the end of a quarter or the end of the year, which probably would be the end of the quarter, but in these sorts of situations, if you have an arrangement with your shareholders that you're going to divvy things up, those would be the dividends for the company, okay? For a lot of small businesses, to be honest, that's not going to be the case. but it is part of the whole financial reporting situation. The cash flow statement slide, okay, guys? So this is the outflows and inflows of cash, okay? And similar to the income statement, this is um, a time span document as opposed to a point in time document. Cash flow is articulated via three different categories: operating activities, investing, and financing activities. And it's all related to cash in and cash out. So, operating activities, that is the normal course of business for your operation. Okay. When you make a sale, or yeah, pretty much when you make a sale or when you have expenses, all right, those are all rolled into your operating activities. So your net income would be an example of cash in, right? Net loss would be cash out. Expenses for things like utilities would be cash out. Money from a sale, cash in. So that's actually a pretty it's a pretty simplistic. It really doesn't have to be terribly complicated, everybody, with regard to like money in, money out of an operation. Investing is another situation. Um, when you invest in your small business, sometimes you need upgrades in equipment, all right? And that's going to be money out that you have to spend, okay? Our printer broke, or we need a new copier. We got to we got to make allowances for something like that. We need to make those purchases. That's money out of our bucket, so to speak. But let's say you're in a situation where, you know what, we've had this company car and it's now time for us to sell it. Maybe we need something a little bit different. You sell that vehicle, I don't know, on Craigslist, or a lot of folks actually utilize their website to sell some of their things, right? And that is money in when you sell that asset, okay? Liquidating investments. Sometimes there are investments for these small businesses. Um, and if you liquidate that investment, that's cash in. That being said, if you purchase some sort of investment or invest in some sort of stock, if that's what your business is into, then that would be money cash. That would be cash out. And then financing activities, that's pretty much par for the course. If you're looking at borrowing, that's cash in. You get those loan proceeds in. And then as you pay your debts down, that's money out. All right. And then getting stockholders, of course, to invest in your company, that would be cash in as well. All right. So that's a little bit about the various financial statements. Folks, I do have one thing that I'd like to share with you, and it is a template that we have in Excel at the Wilkes SBDC. All right. And this kind of gives you a little bit more of an idea of what I'm talking about looks like, say, on an Excel spreadsheet, and as you're doing financial projections, or as you're creating your own financial statements. So this is an income statement. Real simple. This is what I was talking about. Revenue. Your revenue is from your sales, right? Your expenses, or the money out, falls into two general categories: your direct costs, or your cost of goods sold, and your expenses. So your cost of goods sold, what it took in order to make the sale, and then your expenses, the things that you have to shell out, the money that you got to shell out, regardless of whether you're making $0 like a bajillion dollars. That could be your advertising, that could be your insurance, regardless of whether you're making a ton of money or not that much money. You're still going to have things like liability insurance when you get right down to it, right? um, Various licenses, things like salary and wages if you're going to have employees. This is pretty much just a broad overview of what your expenses is. And then as you get down below and you take all those income and expenses options and examples into account, then you're left with your net income. Normally, what we like to do, at least for the first year, if you're starting off in business, is to break out your income statement for the first 12 months of your first year. That indicates to folks that you have an idea, of the seasonality of your business. After that, normally it's fine to just do things from an annualized perspective. Your balance sheet is essentially what you owe and what you own. So this is what it looks like. These are examples on this financial statement of the things that you might have in terms of current assets, cash, your inventory, your long term stuff, as I had mentioned before. Property, plant, and equipment, furniture would be included, but also intangibles like that liquor license we were talking about. What you owe, the accounts payable, short-term loans. Normally, your short-term loans you would think of as kind of like your lines of credit. Things that are payable, your current person long-term debt, and then the difference, of course, being found in your owner's equity. The monthly cash flow, folks. This is the relationship between the balance sheet and the income statement, okay? And this is stuff that revolves around your money in and your money out, okay? So if you had to make inventory purchases, that's money out because you had to shell out that money to stock your shelves, okay? If you had to pay out wages, that's money out, okay? Investing activities, if you sold property and equipment, kind of like what I was talking about before, and if you're looking to purchase property and equipment and other types of stuff in order for you to do business. And then financing, that was kind of articulated with regard to, if you're looking to borrow, if you're looking to issue stock, and if you're also looking to pay your loans back, which if you're borrowing money, you should definitely pay your loans back. And then this is just an annualized example of what your cash flow would look like. So that's pretty much everything that I have to offer for my side of things. Now Lucy's going to kind of delve into the actual bookkeeping intricacies. So Lucy, whenever you're ready.
Well, I do see that somebody has their hand raised, so I
Oh,
thought
I
if
missed
we
that.
address that before I start, it might be pertinent to your section.
Yes, they did enter a comment in the chat asking if Ray, you could make that template available for them to use.
Sure, absolutely, absolutely. As a matter of fact, once I get the attendance list, I can certainly send out the template to everybody.
And also, they asked about the recording. There will be a recording available, and I will email that link to all attendees tomorrow.
Okay. All right. So this is the next slide.
Okay, so my name is Lucy Singer. Prior to coming to the SBDC, my background was banking. I spent pretty much my whole career in banking. So what I'm doing here is kind of telling you why. So it seems like it's a lot of complications. It's a lot of work, and it is a lot of work, but why do I have to do it? So basically, the good bookkeeping, you need that for accurate financial reporting. You have to be able to tell your lenders what you're doing. You have to tell your investors how your company is doing. Basically, you need it for taxes as well. Again, think about Al Capone. He didn't do so well with his tax reporting, and that's how they got him in the end. So it's necessary on a lot of levels. As far as the proper bookkeeping, you need to have it so that should your company need something, you're in a position to be able to present your current standing of the company. From the banker in me, if you can't prove it on paper, then I cannot help you. You might be saying, oh, I paid my employees in cash. First of all, I don't want to hear that. But at the same time, I can't help you if I can't show where your money is going. Okay, so that is basically the prime reason for the good bookkeeping. We'll go through some others as we go on. Ray, if you want to switch slides there. So good bookkeeping practices. So what exactly makes a good bookkeeping practice? So how often do you do it? So you have some things you do daily, some things you do weekly, some things you do monthly. So your daily tasks might be invoicing. Who did you ask for payment from? Making deposits. So you had that day's sales. You have to write down your deposits. How much did you make that particular day? And then you have your cash flow reports. Is more money coming in than going out, which is what we want. Okay, so why do we do this? We need to identify patterns. So if you're doing your reporting daily, at the end of the week, you can see on your cash flow reports that what's the busiest day of the week? What does that matter? It's going to affect your scheduling, first of all. Second of all, is it going to continue that day? How is that going to affect your business itself? But it's good to know these things so you can, help with staffing so that, okay, Thursday is the busiest day of the week. So I have to increase my staffing to keep the customers happy because you want them to come back again. Okay. So, and balancing the books. So monthly tasks, please balance your books at least once a month. I used to have people that would come in at the end of the 12 months, at basically tax time and say, oh, I need 12 months worth of statements. I have to balance my books. Really? It's going to take you forever to do it. Plus, if there's something that went wrong earlier, month 2, let's say, now it's too late to correct it. Okay. So if you hand all those 12 statements over to your accountant and say, oh, well, here's all my statements. No, I don't balance my books, but here's my statements. It's going to take him or her a long time to produce your tax reports. And again, they're charging per hour. So the more money or the more time your accountant is spending trying to do your basic bookkeeping is going to be the more money that you are spending having somebody else to do something that you could have done on a rolling basis and know more about your business than if you were to just hand it all over to the accountant and say, oh, here you go, you do it. Okay. So these things broken down, what Ray was talking about looks like a lot of work, and it is. But like anything, as you break it down step by step, if you keep on top of it each day and each week and do your monthly tasks when they're due, then, at the end of that year period, it's not as intimidating as it might first seem. Okay, if you want to go to the next one. Quarterly tasks. Quarterly tasks are also important. Quarterly tasks, you're going to be paying your sales tax quarterly, okay? So you have to make sure that you have money on hand to pay those sales taxes. And you have to make sure that it's an accurate amount, okay? So with that, you're going to see quarterly, do I have any red flags? What's going on with my business? Do we have anything that is, catching me by surprise? You could find undisclosed fees. You have somebody who's charging you something and you're saying, well, I didn't think it was going to cost this much. I thought it was going to be X. And if now it's X plus $10. So it might be an undisclosed fee that you can find. Or maybe your person that you're using for shipping, they increased their shipping costs and, you didn't get that notice. Well, it's going to show up if you look at your quarterly information. What about a sudden change in a product demand? You have your product or your service and you notice that that one product is just sitting on the shelves. It's been there for 3 months. Nobody's buying it. It's time to look at that product and see if there's something wrong with that product, or is it something with the consumer that has changed? That will all show up as far as quarterly when you're looking at your individual numbers. Okay. So the idea of keeping up to date with everything is not just for the end result of accurate numbers. It's to help your business survive. If you don't have these numbers well in hand, you are not going to be able to make sound decisions as far as your inventory or your services or your suppliers. So these are the ideas that you really need to check out and make sure that you're on top of so that your business can survive, especially in the lean years. And that's when it's going to be most noticeable. Okay, let's go to the next one. So separation is definitely the key. The first bullet point here, business to keep separate are your personal and your business accounts. A lot of our clients end up with a limited liability company because they like that limited liability portion of that particular organization type. The whole point with the limited liability company is to keep your personal assets separate from your business assets. With that separation, since something happened, typically your personal assets are safe from, let's say you get sued. Those personal assets would not be part of that lawsuit. However, if you don't separate your funds, then you potentially could end up having those personal assets subject to the liability of a lawsuit. For instance, if you are paying your personal car loan out of your business checking account, the person suing you could make the argument that says, because the car is being paid with your business funding, then that car is actually part of the business assets. So that's why it's very important to keep your separation between your business assets and your personal assets. If need be, you write yourself a check from your business account, deposit it into your personal account, and then pay your car payment. Okay. Don't lose that liability protection by mixing your funds. That's very important. Another thing that should and should not be mixed are what's going on in your company itself. Okay. As Ray is so very fond of saying, trust but verify. We hear it all the time. You can trust your employees and it's wonderful, but please verify. Don't just hand over the keys to the vault. That's just the way it is. Make sure that no single person is in a position to jeopardize your business. You don't know what's going on in people's personal lives. Their, spouse could suddenly develop a gambling addiction and they're going to lose their house. And they think, oh, I'm just going to take, $500. I'll put it back my next payday. Doesn't always happen. Make sure you protect your business by making sure that you double check these things. Have somebody else double check numbers. If you're making a deposit, dual control was a big thing in the bank. Everything was done with a second person there, so you're making your deposit at night. You put all your cash in your bag, you go to the bank, you drop it off. Okay, so make sure you have a second person verify what's going in that bag and make sure it all matches with what is going to the bank. Because when the bank opens it, they're going to have two people opening it. And if they come up with a different number than you have, that's going to be a burden on you to prove that, it was there when I did it. Well, we have two people saying that it wasn't there. So it's best to have two people verifying what's going in as well as two people verifying what's coming out. Okay, so that dual control is a big thing. There's a lot of different ideas in regard to keeping duties separate, keeping them, verified. And but anything that you need help with, make sure you have, ask questions. How can I best protect my business? Because that's what this is about. This isn't about just, keeping track of what's coming in and what's going out. But it is also, it borders on the fact that if you're not keeping track, it's just not numbers on a piece of paper. This is your actual business life. You have to make sure that you have to keep it alive. And by doing that, you have to double check, unfortunately, pretty much everything. Okay, you want to go to the next one. Leveraging off technology prudently. Okay, so a lot, as Ray had mentioned, a lot of our clients, they're not, computer savvy. They're way more into making their product or creating their service, but not necessarily how to run the business. Computer technology makes it so much easier than it was previously with all pen to paper and little blocks and all that. But you have to know what's out there. Okay, there's a lot of free resources that you can get for education. You can read things like there's education information on LinkedIn. You can listen to podcasts, read blogs. There's new technology out there for processing payments to make sure that your money gets to the account quicker. That might be a big thing for you if you're, barely surviving on that shoestring to start out. You want to get that money into your account as soon as possible. So when I come to your business and I swipe my card to pay for my purchase, that money gets to your account quicker than 3 days, okay? Because you're going to need it. So there's a lot of things out there, but there's a lot of good information, a lot of bad information. So always make sure you get it from reputable sources. Some of the things to consider would be web-based programs, so that you can, no matter where you're at, record your sales figures or a purchase that you made. One of the challenges that we hear a lot are some of the employees that are not as computer savvy have a hard time adjusting to them. Okay. Keeping in mind that, trial and error is a big thing, but education of your employees is a big part as well. Not only for record keeping purposes, but absolutely employee morale. Okay. So that has a lot to do with it, because, if I'm working with entering the deposits again, and, my spouse has some sort of addiction issue, and I accidentally forget to put that $500 in there. Okay, is that an accident? Is that on purpose? You have to know the level of comfort that your employees have with technology, so that, again, trusting but verify, you can see whether or not it's something to be worried about. Okay. Again, technology is good as long as you know how it works, you can explain how it works, and you can follow up and see how it integrates with your business. Okay, you can go to the next one. Okay, so final thoughts. Consider making an appointment with your SBDC to find out how this whole record keeping process can influence your business. Does it look as complicated as you think it is, or is it just that little jobs that need to be broken down? Okay. Think about your bookkeeping needs. Make sure you don't need your one-man shop. You have just a couple people in and out all day. That's fine. You don't need an entire 14-person accounting group looking over your books. Okay, don't make it as hard as you think it is. It's probably a lot easier. But at the same time, if you have questions, definitely ask. Okay, and any questions that you have, write it down, because it's going to come up somewhere along the line. There's a lot of cases where people are just, well, I'll catch up later. It's okay. That's not a problem. We recently had the restaurant recovery grants come through. Now, this was grants, it's free money, but the restaurants had to prove what their quarterly sales figures were. In a lot of cases, they couldn't do it because they had no idea. Okay, so they lost out on free money they didn't have to pass, to pay back to help to recover their business, because they didn't have the accurate bookkeeping. The same thing with some of the EIDL loans and things of that nature that people couldn't apply, or they could have gotten a lot more money if they had accurate bookkeeping perceptions in place. Okay, but it's not just about getting money. Those accurate bookkeeping, you need that for expansion. You need a new machine, or you need to add people. You go to the bank, they're going to say, well, we need to see your numbers. If your numbers aren't accurate and they're not showing that you need money for that piece of equipment, or that piece of equipment isn't going to make any difference, then you're not going to get the loan. Again, investors. Okay, so if you want to bring people into your business and say, you know what, I want to sell you a portion of my business, first thing they're going to ask for is, let me see your books. If your books aren't showing a positive flow, then nobody's going to want to invest in your business. And one thing that a lot of people don't think about as they're starting up is how they're going to end up. Okay, there comes a time where you've worked for 10 years and you decide, you know what, I want to retire. I want to sell this business, or I want to move. I want to sell the business. Business valuations are also based using your bookkeeping for your standard value. They tell you what your business is worth. They tell you if your cycle of cash is going through the business is increasing. It tells it if your product is now decreasing. It's all right there. So when people say, let's see what your business is worth, those books are going to be part of determining how much your business is worth. So it's not just, somebody saying, well, at the end of the year, your taxes, you have to do your taxes. It has a lot more to do than just doing your taxes at the end of the year. Very important to have it for your taxes, but there are other things involved with it as well. Okay. And I think that one's it on my final thoughts. No, that's more. COVID-19. Oh, I kind of covered that with all the, like I said, with the money coming out from the government. Again, you needed your financial statements to reflect what your business was actually doing. Ray mentioned that we are not accountants. So our role is to make sure that you're familiar with some of the basics, verbiage and what each sheet is comprised of, so that you can have that intelligent conversation with your accountant or with your office manager. There are people that they start a business, they hire an office manager because they don't want to deal with the bookwork. But if you have somebody else working with all the books and it's your business, you're still going to be liable for whatever they're putting in those books. Okay. So keep that in mind as well. Again, double check everything. Your accountant is the professional that we keep referring to in this presentation. They are the ones that have the knowledge. They're the ones that are set up to be able to say, you can do a tax deduction on this, or you know what, you don't have to worry about depreciation for this particular item because it's already finished. They're the ones that are going to know all those questions. And again, ultimately, you are the one responsible for the bookkeeping. Doesn't matter if your office manager is doing it, you still have to know how the bookkeeping system works in order to see what's going on in your business. Okay. Crystal balls, yeah, we don't know, not everybody. It's just not something that exists. And you can't guarantee the outcome of your bookkeeping, but it's the fact that you actually do it. You make the effort every day, just do a little bit every day. At the end of the day, write down that deposit, write down those sales. And then at the end of the week, you'll see that, oh, I don't have to go back and do 7 days worth of work. Or at the end of the month, oh, I don't have to do 30 days worth of work. It's all right here already. It's set up that way to make it a little bit easier for you to follow through. And this way, when it comes to the end of the year, you're going to have it all right in front of you. And, when you're on Shark Tank and they say to you, so what was your gross income in, 2000, whatever, you can rattle it right off because okay? So ultimately, it's your business. Make sure you know what's going on with it. Some of the information that we put together to present to you came from these particular sites. And as you can see, a lot of them are .gov or .org. It's just not Wikipedia. Okay, so make sure that, again, when you're getting your information, whether you're listening to a podcast or reading a blog, that they are qualified sources. Okay. Does anybody have any questions?
There is one question in the chat box, Ray and Lucy. Does the SBDC know of any recommended resources for a virtual assistant or bookkeeper who can balance the books each month? I understand the theory and why it is important, but I hate doing it myself.
Off the top of my head, I do not know of one that would be recommendable. Ray, have you encountered any?
Nothing like that. There are certain third-party sources out there, business services that kind of help with things like payroll and other operations relative to your small business accounting. That being said, and I don't know who asked this question, but that doesn't necessarily mean that you're removed from having a robust understanding of your bookkeeping and your overall operational processes. Even if you wanted to outsource that grunt work, in a manner of speaking, to somebody else. And there are a couple out there in the Northeast region. We actually have what's called a referral guide for our clients, our consultant referral guide through the Wilkes SBDC that we can forward to you. And I believe we actually have someone listed that does that sort of stuff. Um, I believe they're actually located in the Bloomsburg area now that I think about it. But don't feel that just because you have that, that you can just um, sign off completely that responsibility to that one operation. You really should have a very robust understanding of what your business accounting is all about before you make that connection, okay? And to be completely honest, when you engage with a service like that, they're going to want to know. And this is why, because like when they're going to take over some facet of that operation for you, their reputation is at stake too. So they don't want to find themselves in a situation where, it's like, we've signed up for something, their books are a mess. Oh my goodness, what do we do now? What did we gotten ourselves into? So again, even if that's something that you're interested in, make sure you um, make sure you clean house before you connect with somebody who can maintain certain aspects of the operation for you.
And there's one more question in the chat. Is there anyone that can offer assistance to help set this up and show me how to do it? So
Well, make a if you don't mind me saying, make an appointment with your consultant. Now, I'm guessing if you're on this call, maybe you belong to our 5 county region, but if you don't, then seek out the services. And let's have, between you, maybe it's Lucy, maybe it's me, maybe it's another consultant in our area, but let's definitely have a conversation with what your needs are before we plan some sort of attack, some sort of strategy with regard to your bookkeeping, okay? Um, but from that initial conversation, we can figure out a strategy. Quite honestly, like I said, and what Lucy has said before, is that we're not accountants. So it might be a situation where once we have that initial discussion, it might make sense for us to bring in a CPA or other tax professional. The one thing that Lucy and I and the rest of the consultants do, however, is that we can have those conversations, we can have that initial strategy planning. And when you graduate, in the manner of speaking, to that tax professional, you can have, as Lucy had put it, intelligent communication conversations, so that you're not starting from square one. You're starting from a place of strength, from a foundation of strength.
all right, and it looks like there is one more question. To help save expenses, do you recommend any virtual receptionists instead of paying employees to answer phones?
And again, I think that really depends on your business needs. You can take a look at it and say, would it be less expensive to hire a part-time receptionist for my busiest part of the day versus, doing the virtual receptionist for, 8 hours a day, 5 days a week. And again, that's your individual situation. So it's basically weighing the pluses and minuses and see which one is going to serve you best for the least amount of money, really.
Let me ask this, and I don't know who asked the question, because for whatever reason, my Zoom, like at least from my computer, just absolutely hates me and is a little passive aggressive and won't let me know who is talking and who's not, or who's having conversations, comments, and who's not. But what's the nature of your operation? Because maybe it makes more sense for you to encourage your potential and existing clients to access like your website. And if you ever take a look at your website, there's usually a section that says contact us, right? And then you put the name, the phone number, your email address. And if you're real savvy about stuff, right? Maybe you have like some sort of preliminary survey so that you're able, without a lot of effort on each other's part, you're able to identify specific needs. All right. So when you enter in that contact information and you have those specific needs articulated, that reaches you, and you're in a better place to offer guidance or products or direct your clients to services that your operation has to offer. And that way you're not wasting anybody's time. In that case, in the situation of, because, right, how annoying is it when you pick up the phone and it's like ringing and it's ringing and nobody's answering the phone and there's nobody there? But if you have some sort of alternate way where not only you can send the message off, but also articulate your needs, that puts you as a business owner in a better position, to service that client. And I think that's going to be a place where everybody's happier in the long run, if you think about it.
All right, it doesn't look like there are any other questions in the chat box. So we can go ahead and wrap up the webinar today. I'd like to thank Lucy and Ray for being here with us and sharing their expertise with us this afternoon. Just a few housekeeping notes that I have. I will be making available the recording of this training on the Wilkes University SBDC YouTube channel, and I will email that link to all attendees. I'll also be emailing the link to a post-event survey so that we can determine which of our resources will best suit your needs and what topics you would like to see in the future. And finally, we have a new 5-part webinar series beginning on Monday, April 26th at noon, titled Marketing Mondays, a digital webinar series. And the series will be hosted in partnership with Cole Creative and IdeaWorks Marketing. The sessions will run for 5 consecutive Mondays from noon to 1 p.m. and is geared towards creating and improving your small business's digital presence in a post-COVID world. And if you're interested, you can sign up for that through the eCenter. With that, I want to thank everyone for attending this training. And if you have any questions, please don't hesitate to contact us at the SBDC. I hope that you all have a wonderful rest of your day, and I look forward to seeing you at future webinars. Thank you, everyone.
Thank you.
Thank you.
Bye.